have on the owner equity component of the balance sheet. Uh, this may get a little bit complicated because it's actually split into two parts. The owner equity component for partnerships and sole proprietorships is easy. It gets a little bit complicated once you start taking a look at corporations. So let's start with just what it would look like for a partnership or a sole proprietorship right now. And commonly what you'll see there is just the owner of the firm's name, and it's usually referred to as some kind of capital account. So the number next to it actually represents how much of the firm that particular owner owns. And if you have a partnership, you just have two lines. It's that easy. So you just put in whoever you want goes right there. You can actually do things like talk to the accountant and say, hey, I need $1,000. And what happens is they'll reduce the amount that you have in your capital account by, say, $1,000, bring it down to $9,000. And what will happen then if you go up to the top of the balance sheet in the asset section, you'll see a reduction in cash that's there. And so that balance sheet equation still works here. All we're doing is just demonstrating for you the part that the owners actually own. So again, the owner equity component for a sole proprietorship or partnership is really easy. Now, moving over to a corporation, things are a little bit different because ownership is divided up into a couple of different ways. Now, the first thing that I'm going to go ahead and pop in here is that you'll often see two different kinds of stock, two different kinds of ownership. And I've created for you here a kind of common shareholder and a kind of preferred shareholder. Now, what's going on with this kind of ownership is that there's a line in order to have a pull on the earnings that take place. Preferred shareholders get to come first. Common shareholders are the residual claimant. They're the last one there. What preferred shareholders get to do is they collect dividends up until a certain point, and after they have received their dividends, the common shareholders get to go ahead and have a claim on whatever's left over. Preferred shareholders, although they do have first claim, have a limited claim. So it may be that, say you've got stock that's sold, in this case for $100, they may have a 10% dividend rate, which means that they have a claim on $10, at most $10 per share worth of earnings, and anything on top of that goes to the common shareholders. If you can only pay the preferred shareholders, say, $5 per share rather than the 10, they get the $5 and the common shareholders get nothing. So the preferred shareholders are essentially first in line. Beyond that particular distinction, let's look at how the ownership is actually arrayed there in the owner equity section. Now, the first thing that you're going to spot is something that says common stock. Now, that line is not going to be the biggest number in the world, because what that's going to be is the common stock at its par value. You can think of par value as the face value that you see on a coupon. The reason for it has some kind of historical significance. Some states require you to have par value, some don't, but it's supposedly some kind of minimum amount that the stock's supposed to be worth. In this case, what I've done is I've set the par value for the common shares at $1 per share, but you'll see some states where you can have it for a penny a share. Now, just because the par value is set at $1 per share doesn't mean you're going to sell them for $1 per share. What I've done here is said that we're going to sell 1,000 shares, and we're going to do it for $10 a share. So while you may be having in this particular category, in this particular account, just $1 per share for the 1,000 shares, that part that you sold the stock for above and beyond its par value goes into an account that's either called excess contributions or paid-in capital, or you'll see some other names for it. But it is just supposed to be the amount that you sold the stock for initially above and beyond its par value. So just to clarify, what I'm doing with the common stock here is I have 1,000 shares, I'm selling them for $10. Altogether, you're collecting $10,000. 1,000 of the 10,000 goes into the common stock account, and the other $9,000 goes into the excess contributions account for common shareholders. You have a similar situation with preferred stock, and so what I've done here is I've said, well, look, we've got some preferred shares. There's only 10 of them, but they are being sold for $100. Now, if these things also have a $1 par value, you'll see $10 in that preferred stock account. And the preferred paid-in capital or excess contributions will have the balance of what you originally sold the stock for. Now, the final line that's up here are the retained earnings. And this is the accumulated net income, something that comes off the income statement. that has not been distributed to the shareholders in the form of dividends. And this is a big chunk of money. It is those accumulated net income. It also represents part of the owner's share of the firm. And that should complete the shareholder and owner equity